Let me welcome in our guest, Mayuresh Joshi, Fund Manager at Angel Broking, who joins us now. Mayuresh, always great to have you on the show. I'm going to start off by asking you that you've done fairly well as a market, coming up to about 7,900, a bit of cooling off at those high levels. The results so far haven't been bad because Infosys did cheer sentiment. What's it looking like in terms of valuations? What's your gut feel? Do you see the markets continuing its rise up?
Afternoon, Minnie. I think yes, the first set of numbers that the IT companies have posted, specifically in terms of what kind of guidance they have meted out, has been taken extremely positively by the street. However, I think the larger pack of earnings coming through from the banking and financial space is largely going to be watched out for. What really happens with capital goods stroke infrastructure as a space as well needs to be watched out carefully as well. So clearly the markets are not expecting a great set of numbers to come through, specifically in the second half of the earnings season, when a lot of these sectors will start reporting numbers. So for a structural re-rating, I think I've always maintained that earnings need to revive. I do not see that happening till the second half of this year. That will get boosted and coupled with the fact that if the private capex does follow through with government spending expected to come through, you will see corporate earnings grow at a very decent clip in FY17 at 14-15%. with the assumption that the nominal GDP should grow at around 12%. So again, the markets are set for a structural re-rating from the second half, but whether that comes through largely depends on these two factors. And clearly till that point of time, our own take is that the markets will consolidate, try to find out short to medium term triggers. Monsoons might be one of a trigger in the next month and a half. The global events will keep the markets volatile as well.
Let's pick up some of the news items and then get Mayuresh's views on them. Starting off with metals, and the counters over here are in focus today, as Credit Suisse has turned bullish on the sector and upgraded select names. The brokerage expects a significant leg up for steel as domestic prices rise. My colleague Piyush Jain joins us for more. Piyush, this is the first emphatic upgrade in the metal space. There has been such a lot of concern around this area. Take us through what the contention is.
For Credit Suisse, it has been a long time. So this upgrade is significant as basically they are turning on metals from overweight to underweight. Now in the metal counter, they basically have three major picks: Tata Steel, JSW Steel and JSPL. They have outperformed rating on all the three counters. Before we talk about the stocks, let me highlight the four major points what they're making on the Indian steel sector. They're saying that the domestic steel prices have increased by about $50 to $60 per ton. So that's going to be, directly flow into the EBITDA. Number two, the international outlook for commodities and steel has improved. Since January, we have seen weakening of dollar. We have seen basically lower than expected depreciation yuan. And also basically since the inventories, they have declined from 2014 till now in China, a restocking cycle is expected to happen. So all of these could be positive for commodities going forward. Now let's talk about the stocks. Tata Steel, basically Credit Suisse is saying that the disposal of the UK operations would be a major positive for the company because it's going to remove the drag of the UK operations by about $360 million. So that's a big positive. The second is the increase in the domestic steel prices again going to help the EBITDA. They're expecting the FY17 EBITDA to rise by about 90%, and also the FY18 EBITDA has been increased. The estimate has been increased by about 18%. Overall, again, the same argument for JSW Steel. But for JSW Steel, the two more drivers will come. One is capacity expansion has taken place for about 14 to 18 million tons per annum. And also since the MIP was enforced, the MIP basically had benefited more for the flat steel producers. And JSW Steel has about 80% exposure to the flat steel. So that's what Credit Suisse is saying, that JSW Steel will be the prime beneficiary of that. For JSPL, they are saying the asset monetization plan will be the major catalyst. And as they pursue their asset monetization, along with the price, companies also going to benefit from the balance sheet deleveraging. About 88% of the balance sheet of the enterprise valuation for JSPL comes from debt. So as monetization happens, it's going to be positive. Overall, for the steel sector, Credit Suisse says the strength in the steel prices bodes well for the sector.
Right. There is a lot of news around metals, and Piyush gave a snapshot of that. Of course, global metal prices have also been on a rebound. Mayuresh, what do you make of this space? Because, you know, in the last month and a half, since we saw the metal prices start going up in the global commodity play, we have seen sharp swings in the metal counters. But this is the first time we have got an emphatic, upgrade coming in from a firm like Credit Suisse. which says that fundamentally things look different. What is your take on it?
Again, things are changing for the better, and it's not just the rebound that you're probably seeing in international prices. One really assumes specifically for domestic operations with the imposition of MIP, as Piyush was mentioning, the end realization should probably start showing up, specifically for flat steel makers. However, I think, in my opinion, I think for a structural re-rating for these counters, the demand environment has to improve drastically. The kind of inventory that you're probably carrying in the first half, I think that needs to get disposed of first. So I think you're looking at a lot of permutation combinations happening on this front. The input costs basically are still very, very benign. And though the prices have moved up on a quarter-on-quarter basis, when you talk about coking coal, iron ore, bitumen, I think they're still extremely low compared on a year-on-year comparison. So in that respect, the end realizations are expected to improve, but the basic tenet on which the steel companies should do well is how the volume recovery happens. So I think this result will be extremely important to understand how the production estimates for a lot of the companies are expected to pan out for the coming fiscal, what kind of offtakes they are expected to assume for the coming fiscal as well. And that will have a very positive impact if the commentaries are good in terms of how the margin expansion will happen and how it trickles down to the bottom line. So clearly at this point of time, a wait and watch. I think results are going to be extremely pertinent for a lot of these ferrous and non-ferrous players as well.
What would you buy over here, if at all?
Again, I think the larger names. So I think you've seen a rebound happening in aluminium prices. I think if the demand outlook there looks extremely encouraging, the aluminium players look like a very interesting proposition. Zinc, lead, again, I think you're seeing some amount of rebound happening on that prices. So any volume growth trajectory expected on these two commodities, specifically both on the international scene as well as the domestic scene, I think that should help shoring up both volumes and end realizations for companies catering to these commodities. So I think these three commodities is basically what I'll be looking at, and the companies serving these commodities, I think, should benefit if it pans out positively for them over the next 4 to 6 quarters.
Fair enough. Let's shift focus from metals to IT. Those are the two themes that the markets are looking at today. IT major Tata Consultancy Services fourth quarter numbers have come in marginally above street estimates. Both profit and revenue have seen a slight uptick. We caught up with N. Chandrasekaran, MD and CEO at TCS, to talk about the quarter gone by and the company's plan going ahead. Listen in.
I think we had a very good volume growth for a seasonally weak quarter. It's a 3.2% volume growth. And our core sectors, BFSI has done very well with 2.4% ahead of the company average. And key markets, North America has done about 3.2%, and Europe also has done extremely well at 3.3%. So I think it's been a good quarter with all the core sectors, BFSI, manufacturing, life sciences, everybody delivering. Digital, we have been saying, is a very key sector, and we are seeing a lot of transformative opportunities, whether it is analytics, whether it is cloud, whether it is mobile and channels and marketing and so on. And we are seeing all these things come together. Our contribution of digital as a percentage of the overall revenue has gone up significantly and crossed the 15% mark. Also our platforms are getting a lot of traction. So we believe that the momentum in digital will continue. Positive about where we are. I think we have a very good momentum as we exit FY16. Core verticals, BFSI, retail, manufacturing, life sciences and other verticals are doing well. Core markets, including the US and Europe, are in good shape. And some of the headwinds we faced have bottomed out. So given all that, I think we should have a pretty good year.
That is N. Chandra speaking to my colleague Swati earlier. Mayuresh, what did you make of the TCS numbers, and why are the markets so disappointed, do you think?
Numbers are quite reasonable, in my opinion. And again, if one looks at the management commentary and trajectory, I think they're expecting a lot of issues pertaining to Diligent, LATAM, Japan basically bottoming out. Secondly, I think the management commentary itself has been very robust in terms of both client mining and the expectations of discretionary spending going up. So in a comparison basis, I think the volumes have probably met street expectations. You're probably looking at EBIT margins a little bit soft this quarter around, But again, I think we're largely factoring in 26 to 28% kind of an EBIT margin range for TCS. The attrition levels have stabilized. You're probably looking at utilization levels inching upwards. So the kind of tailwinds that one really expects for top tier IT companies to come through the next 4 to 6 quarters should start accruing to them over the next few months, and that will have a positive impact in terms of how the numbers pan out. So yes, as a space, I think we remain extremely positive on the top tier IT companies.
Right, let's shift focus to the housing finance space and HDFC in particular. Actually, HDFC is moving towards realizing the HDFC Life IPO dream. It has begun the IPO process of the insurance arm. KK Mistry says the IPO is likely to hit the market by the year end. Listen into what he had to tell us.
The regulators would, look at the offering document very closely because, it sets the benchmark for future IPOs in terms of disclosures and stuff like that. So how long that process will take for the IRDA to give the approval. After IRDA approval comes, we need to go to SEBI, get the SEBI approval. Then market conditions being right, we would look at doing an IPO. So I would think sometime in the October to December quarter is the best that we can hope to do the IPO if it is to happen in the current calendar year. It's an in-principle approval that we've taken from the board to do an IPO of up to 10%. So it's not necessarily 10%, it's up to 10%. Unless we talk to the bankers, we cannot give you a sense of what the valuation would be. But there are enough sell-side analyst reports on HDFC, and many of these reports do carry a value for the insurance company. So you may get some sense of what the valuation is from these reports. The Standard Life transaction happened a year ago, or well, at least it was discussed, pricing and everything was discussed almost a year ago. They had participated in the growth of the company and they had the option to increase their stake to 49%, which they partly gave up and said that they will rest their shareholding at 35%. So all this was taken into account while arriving at the valuation at that point in time.
That's KK Mistry out there. I would like to pull out the year-to-date chart of HDFC. Look at the volatility on that stock. I mean, it was a very, very stable, solid kind of a counter in most cases. But in this period of 4 months, we've seen sharp swings on that stock. It's gone all the way down to 1022, risen to about 1168, and fallen back to 1070 before rebounding. Mayuresh, what's happening on this, and how would you play the story of the insurance arm getting into IPO mode? Because, the last couple of insurance, after the FDI was changed over there, it hasn't really panned out the way most people thought it would. It's not been an easy road to IPO and move ahead.
It has not been, and you're correct on that aspect. And if one really looks at how the first year premiums have panned out for insurance companies generally, I think they've been on a very soft wicket. Having said that, I think the numbers at least of HDFC Life look promising, but again I think as Mr. Mistry was pointing out, I think one really needs to understand what kind of valuations the bankers come out with. So I think the embedded value will be very, very key and pertinent at this point of time. What happens with the ratios going forward, the conservation ratio, the solvency ratio, what kind of an expense ratio they maintain. I think all those parameters can then be done on a peer comparison check with a company like Max Life, which is probably currently listed. So I think that comparison check needs to be understood very, very clearly. When you talk to the core business, I think the kind of base that HDFC was probably working with, I think it's very difficult to repeat the performance quarter after quarter. So I think the other housing finance companies probably are filling up the valuation gap. They're also filling up the premium gap that HDFC enjoyed. And clearly, I think the other housing finance companies, apart from HDFC, at least look attractive even on a valuation perspective, considering the current business environment. So I think housing finance companies generally should do well over the next couple of years. But because of the base effect that HDFC has and the valuation premiums that it gets, I think the performance might be a little bit subdued going forward as well.
Also, the volatility in the stock?
So again, largely it's a factor on how the numbers are expected to come out and what performance the company actually gives, and this precisely is the point that I've been raising. I think the base itself is so high that it is not possible for the company to keep on beating the base year after year. So at some point of time, you'll see consolidation probably happening in terms of both their advances growth, in terms of how their asset quality is panning out, and the kind of premium valuations that the street then derives or gives to the stock probably gets curtailed when numbers start consolidating. So I think you need to give a consolidation period to the stock, and then the upward trajectory might start again in a very progressive business environment where other housing finance companies can do well as well. But the gap between HDFC and the other housing finance companies should start narrowing down. So the other housing finance companies, because of a low base, have probably got a better advantage at this point of time.
What's happening with China? Is that becoming a little bit of a concern, Mayuresh? Because I think from the budget onwards, we started looking inwards really for triggers. First it was, of course, the budget, then the big run-up, then the rate cut, then now it's going to be the earnings and then the monsoons. But we did see Shanghai, and we should see it today and not in the 3-month context. The Shanghai index came off the lows of the day, but it did fall pretty sharply, down about 4%. How are you looking at the global cues, or is India going to look very, very well within in the next couple of months?
Again, our performance will be largely determined from a medium-term perspective to how, in the manner the global markets react. So what happens with China, the data points coming out of there, what happens with ECB, what happens with the US economic data, with the housing stats, the unemployment data. I think all these points need to be monitored very, very carefully. I think the kind of growth estimates that IMF has come out with and lowered growth estimates on the global side, again, are pointing that the economic recovery is going to be a very slow and a gradual process. So it's going to be very, very painful, specifically for global economies, to show a bounce back and economic resilience to start coming through. And that might also probably reflect in terms of how funds might come through. You might get short-term hot money probably into the Indian market, but for long sustainable money to come through, I think both these conditions need to be fulfilled. You need the global economy to stabilize. At the same time, I think all the factors that
we seem to be having a problem with Mayuresh's line, but in a nutshell, yes, global economy going to be very crucial, and we are still not out of the woods over there. Well, we leave it over there. Up next, we have Arvind Sanger from our Market Guru segment talking about how the worst of the NPA story is over and things can turn around soon. We come back with that.
The March quarter could bring a few potential surprises in terms of people who recognize larger NPAs than expected. But I think largely that story is played out